Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and in today's episode, what we're going to be going over is two big pieces of news. The first one that I want to be talking about, and the main point of this video, I want to be going over the big news that Robinhood just announced. Robinhood is one of the main competitors to M1 Finance, which is this brokerage that I'm highlighting in this video. But Robinhood is arguably the most popular retail investor platform. They basically democratized investing for retail investors, and they offer no fees for investing, and basically was one of the first ones to do so. Also, lots of extra features over the last couple of years, including debit cards and margin accounts being offered at only 2.5% interest rates. Robinhood Gold features, fractional shares, which was mainly came from M1 Finance, but lots of features that came to M1 Finance over the last couple of years. And this one is arguably the biggest one of all because this one is going to be huge. Robinhood will give retail investors access to IPO shares, and this will be offered at entry-level IPO prices. So no longer will companies have to be offering their IPO price at $50 a share, and then retail investors forced to pay whatever the price is at open, whether that's $60 a share or $75 or even $100 a share. Retail investors now have the opportunity to have access to early IPO shares. So we're going to be going over that in this video and how that will be affecting M1 Finance, the brokerage industry in general, and also we'll be talking about performance of IPOs both pre and post IPO and looking at market gains during regular and post hours as well. And then after that's done, we'll be transitioning the video to something that's a little bit out there, a little bit different. We're going to be looking at the holdings of Michael Burry, and the main holding that it has right now is puts against Tesla. Now, it's not confirmed right now if that position is still open, but it recently was announced that he did, or still does, have an extremely large put position against Tesla, the automobile company. Now, he has a lot of other main holdings as well that we're going to be going over in this video, and the two that I want to focus on is his position in Tesla, but also his position with TLT, i.e. the long-term Treasury bond ETF. I'll be going over that in this video and talk about how him, as well as a lot of other big hedge funds out there, have been taking out record number of short positions against long-term Treasury bonds. So this is going to be an action-packed video, lots of information to go over. If you're not familiar with me, my name is Jordan. I'm a millennial investor. These are the 22 companies that I have listed right here in column A that I'm highlighting right here with my mouse. And this is my annual and monthly dividend income tracked on my monthly charts right here, as well as my portfolio value and my monthly YouTube income. The 5 investing goals for 2021 listed right here, my 2021 stock market prediction. As you can see from one of my goals is to get 150 referrals to M1 Finance. Like I said, this is a free brokerage with lots of great features and offerings, and this platform offers an opportunity to get $30 to get signed up with M1 Finance. So if you go down below in the description, there's lots of other things as well, including getting signed up with M1 Finance for $30, mentoring calls if you want to speak with me directly, you got savings accounts, credit card referrals, all that stuff. So if you want to check out that stuff down below, go ahead and scroll down to the bottom of the description and you'll see all those links posted. But let's go ahead and get started with the first piece of news, and that's Robinhood. Now, instead of reading the CNBC article and giving the news version of this, let's just go straight to the source. Let's close out of this and let's go directly to Robinhood.com. And this is the news article that they posted on May 20th, about 2 weeks ago, announcing this Robinhood IPO access to retail investors. Now, the paragraph that it starts off with says, "Today we're starting to roll out IPO access, a new product that will give you the opportunity to buy shares of companies at their IPO price before trading on public exchanges. With IPO access, you can now participate in upcoming IPOs with no account minimums. Most IPO shares typically go to institutions or wealthier investors. With IPO access, everyday investors at Robinhood will give the chance to get in at the IPO price." And then how it works is that you discover upcoming IPOs from the list of participating companies that plan to distribute shares to Robinhood, and you can also follow these companies to stay up to date on milestones and read their preliminary prospectus to learn about the business model, management team, and risk factors. Then step 2, you request to buy shares of companies at the initial listing price range. When the final price is set, you'll be able to review, edit, or cancel your request before shares are allocated to Robinhood customers. Then you watch and wait. IPO shares can be very limited, but all Robinhood customers get an equal shot at shares regardless of order size or account value. Now, this is huge, and the reason why this is big is because I want to give an example of some IPOs that have went public within the last couple of years. So one of the ones that is my favorite, one of my absolute all-time favorite recent IPO companies is Beyond Meat. This is a company that, for example, when it went public, you see that it first traded prices at around $65, $75. The initial listing price was $25 a share. $25. So if an investor was wanting to buy into a company like Beyond Meat, which by the way, at that initial IPO price would have been an incredible investment in just a short they went public in the middle of 2019, May of 2019, and now it's June of 2021. So in 2 years, that initial stock price is what is that? So that's 6x from this price almost, a big uproar from there. But if you're instead investing at the public price when it was finally traded public in the stock market, if you weren't one of those wealthier investors, you would have been buying at $65, $75 a share, and that barely would even be a double up from these prices, right? And then there's other ones as well, a company like Snowflake. Snowflake IPO was one that had a lot of hype, a lot of excitement around it, and so far has done okay since its initial announcement, but this company just skyrocketed in IPO price. And it is not just with this company, it is across the board over and over. You see this every single day with exciting IPOs. People get excited and pumped about the price, and it ends up skyrocketing in price. A company like DoorDash pretty much doubled in price from the moment that it went public. This happens over and over and over again. And who's the ones to benefit from this? It's the people that have early access, primarily wealthier investors, that have early access to buy a DoorDash at $90 a share pre-IPO price and then cash out big once it initially goes public. So if Robinhood is offering this to the public, this gives people to finally get a chance, regardless of their status, regardless of their wealth, to get a chance to invest in real IPO prices, not some hyped up number that people hope that they can make money from quick. Real IPO prices. So that's really going to be interesting there. And I think that this is going to be the new transition. In the same way that Robinhood was the first one to really initiate free trading on brokerages, I think this is going to become the norm across the board. I think that eventually, it will take some time. It won't be next week, won't be next month, but I think that sometime between now and the next decade, it will kind of just be the norm between a Fidelity or a Charles Schwab or an M1 Finance to offer pre-IPO listing prices on their brokerages, just like it is offered to other wealthier investors. I think this is a cool opportunity, and once again, just gives people more power and gives Robinhood some leverage for being the first ones to do this. So hats off to Robinhood. While the platform has made an incredible amount of mistakes, this really is cool to see. Now, I wanted to talk about one more thing. This goes further with the whole pre-IPO listing price, right? When we look at the stock market returns going back to 1993, okay? This was a study done by the Bespoke Investment Group and the New York Times analysis, and this was posted in the New York Times. So this is what would happen if you bought 1 second at market open and then sold the second before the market closed. So basically every day you bought and sold at the very beginning and the very end of just regular trading hours. You would see that your performance going back from 1993 during some of the best bull markets ever with the dot-com bubble, and then we have the roaring 2010s and even the beginning of 2020 being incredible, right? You have all these great times in the market. The last 20 years or so have been pretty good to markets. But when you look at 1993, going all the way to today in 2021, you actually have a slight negative return. Now, what about the complete opposite? Now, what if you were to buy the last second before the market closed and then sold immediately at market open, 1 second into the market opening? Not only would your return be much better, but it would be astronomically different. It would be almost 600% returns, and that is dramatically different than trading during regular hours. Now, what does this tell us? This tells us that traditionally, a lot of movement in the markets, primarily most of the movement in the markets, doesn't even happen during regular trading hours. It's during pre-market and post-market that a lot of this news gets priced in, primarily the pre-market, because a lot of big news and economic data will come out either early in the morning, and then a lot of investors will start to price in this good or bad news. And this also gives an opportunity for a lot of wealthier investors that have access to full extended trading hours that a lot of retail investors do not have access to. And so this goes to show that this doesn't mean that you should start selling at the market open and buying at the market close. That's not what I'm saying. But this just goes to show that prices are not always black and white. It's not always going to be during regular market hours. And actually, most of the action happens outside of when most people are actually being available to trade. And the same thing goes with IPOs. So if M1 Finance ever initiates an opportunity like this in the future, I think it will be big for the platform as well, just like it will be for Robinhood. Now let's go ahead and close out of this, and let's go ahead and focus on the next piece of news. I want to talk about Michael Burry. Michael Burry of The Big Short reveals a $530 million bet against Tesla. And it's funny because literally just a couple of days ago, I introduced the movie The Big Short to my friend because it's one of the best, it's arguably the best finance movie that's ever been created. Right up there among Margin Call, The Big Short, The Wolf of Wall Street, lots of great movies that are related to finance and investing that is absolutely incredible. And Michael Burry was the main star of The Big Short. Now, if you haven't seen it before, The Big Short was obviously a famous bet against the housing market that happened in 2008, 2009. And not only did he make it out alive, but he profited massively from the subprime mortgage crisis that happened a little over a decade ago. Now, regardless of that, we're not here to talk about that, what happened in 2008, 2009. I want to talk about his main position. His main position, as of the time that he filed this 13F, once again, we can't know for sure if he's still in this position. He may have sold out. He may have increased his position. He may still be holding. There's no way of really knowing. But Michael Burry made a huge bet of $530 million buying put options that are going against the shares of Tesla. Now, if we go ahead and go to our research tab here and we search Tesla, this position would have been initiated right around the beginning of the new year. So sometime probably in January, February, March. And during these times, so let's go to the start of the year right here. So during the beginning of the year, Tesla was $730 a share. And during that time, from then until the end of March, Tesla traded somewhere around from $600 a share to the low 600s, upwards of almost 900. I think at one point it actually touched 900. So if he would have shorted it anywhere between this level, anywhere between $700, $800, $900, and I'm guessing that he likely bought puts during these peak of $800 and $900 a share, then he likely would have cashed out big. Because this company has already been down 30-40% plus from the levels that it was at $900 a share. I mean, just 900 to 600 is a 33% decrease. So likely, if I were to guess, he's already made a lot of profits on this bet and probably cashed out. Now, that's great for Michael Burry, and he did make the position almost 40% of the entire capital that he managed. So a huge bet. Obviously, if this would have went negative, this would have been a really big downturn for Michael Burry. But that's not really what I care about, and that's not really what I wanted to talk about in this video. I wanted to talk about his second largest position that I think a lot of people aren't really talking about, and that's the Ishares 20-year plus Treasury bond ETF. And basically what this is this is an ETF that holds long-term Treasury bonds. It's that simple. It specifically holds Treasury bonds that are 20 years and up. And today, it did have a big green day, which for a long-term Treasury bond, a 1.3% green day is a pretty big day. But this ETF, while it holds long-term Treasury bonds, has seen a lot of great returns, specifically over the last 2 or 3 years, because interest rates have went to ungodly low levels. It have went to levels that are so low, it's almost unfathomable how low the long-term Treasury bonds have been trading at, especially during the early times of 2020, right? Now, basically what he's betting is that interest rates are inevitably going to go up. And if interest rate goes up, what happens to long-term Treasury bonds? Well, you guessed it, they're going to begin tanking. And I think that if interest rates were to start getting raised, this portfolio, this ETF, would definitely start to go down. And you can buy the options on these for dirt cheap because the volatility is so low. Now, what's really interesting is that Michael Burry is not the only one here. While he's made this position, about 12-13% of his portfolio as of the time that this was filed, this was all announced just within the last couple of months. This was all made at the beginning of 2020. Now, if we go to this chart here, this shows the U.S. Treasury bond long and short positions. And obviously, the line 0, if it's up, if it's over 0, that's net long positions. People are betting that Treasury bonds are going up in the near future, right? And then obviously, if it's below 0, people are short. People are shorting against the bonds. They're betting against them, betting that they're going to go down. But Michael Burry is not the only one. You see times during 2010, people are going short, 2011, 12, a big time in 2015, one of the biggest ever. And then we fast forward from 2018 and beyond, especially in 2020. This is how many people are shorting United States Treasury bonds. People are shorting them at levels that have never been seen before. And so, what I think is really interesting here is that people are seeing an opportunity to short long term Treasury bonds and basically hedge against inflation so that way they can profit whether or not inflation rampants against stocks or not. If stocks don't get affected from inflation, they probably have plenty of long positions, just like Michael Burry does with Google calls and Facebook calls, and this company's and those companies are going to benefit if inflation does not ramp up. But if inflation does ramp up and it really starts to hurt long-term treasury bonds, hedge funds and other people like Michael Burry are shorting heavily against the long-term treasuries. And I think it really opens an interesting discussion towards interest rates and where the long-term treasury bonds are going moving forward. But anyways, guys, thank you guys for watching all the way to the end. I really appreciate it. Like I said, $30 to get signed up. We've signed up 112 people so far. Let's get that number a lot higher. But thank you guys so much for watching, and I'll catch you guys next time.